Well, in a year of wild stock market rallies, this one may truly be a rip-your-face-off rally. As Bob Pisani noted, we have jumped about 1,000 points in just 5 sessions. But look at how volatile this year, especially lately, has been. I mean, this is an amazing run, but this is not the only one that we've had to the upside. All right, we can go back all the way, let's say, whatever, March to April, right? We're seeing a pretty big move here. We jumped about 800-plus points in that time period. June 24th to July 27th, right here, we had a nice big run. That was about another 800 points on the Dow. August 10th to August 15th, here, we had one here. And, of course, we've got the one that we're in right now. And you say, well, these are nice rallies, Brian, but notice that we've dropped after almost each one of them. And some people might argue that while it is nice to have a run to the upside like we've had now 5 times this year, even going up this quickly shows just how broken this stock market is. Let's talk more about that. Walk with me. This is how we have to do it. We have somebody off today. We got Joe Saluzzi here. We've got, I know it's great to see the back of me. That's just wonderful. Joe Saluzzi at Themis Trading. Great to see you, buddy. Thanks for coming in. I'm not supposed to shake your hand, but I will because that's how I was raised. Herb Greenberg, thank you very much. All right, so a lot to do here. I believe we have another guest as well who's out there in TV land. We'll get to him in just one second. Joe, the point I was trying to make inelegantly was basically that, hey, I know we love to go up. There's this up bias. Sure. But is it bad for overall faith in the stock market when we have the runs up as well as down this fast?
There's no doubt. $90 billion has come out of domestic equity funds since May. Okay, $90 billion. So that tells you the confidence is not there. People are getting very concerned about these types of moves. The moves happen because of the type of volume that's in the market. Short-term fleeting liquidity like we spoke about. Those moves are amplified. The real buyer may come in during the day, but it's a parasite host, right? They're amplified by the high-speed traders who just want to get ahead of them. That's what's going on with the markets. The markets are broken. You have to question, here's the big point, is price discovery really happening in the stock market, or are we just some correlate? No.
No price discovery?
Well, not on a short-term basis. In the long term, we will eventually find the prices. Short term, we're tracking things like the euro dollar, the Aussie yen cross. We're tracking everything but the fundamentals of the stock market.
I think we have Tim Holland of Tamro Capital with us as well. Tim, you there?
I am.
Tim, do you agree with what Joe is saying, that these wild swings just destroy confidence, whether or not they're to the upside or the downside, because of the whole price discovery issue?
I do. I mean, you want the individual investor to believe in equities as an investment, long-term, near-term. You want capital to come into the markets. It's important for the economy long-term, but you also have to step back from near-term volatility and think about volatility also as creating opportunity. And we're stock pickers at Tamro Capital. We build our portfolios one stock at a time. So in unpleasant periods, we do what we always do, which is try and buy the best when they're depressed. And then ultimately, I think the price discovery function of the market will come back to the forefront.
Well, you know, Tim, this is Herb. Joe had said that he thinks the markets are broken. And when you think about the markets, you think of investors. And we've been talking about this for quite a while, but it just seems this is a market that has very few investors, lots of traders. What does that mean going forward?
Near term, it adds to the overhang. It hurts sentiment, Herb. I think you're absolutely right. And if you think about the last 10 years, it's been a very tough period to be a long U.S. equities investor, right? 2 recessions, the flash crash, the credit crisis, and here you are 10, 11 years later, and at best you're marking water. Worse, you're probably down a lot because you bought and sold at the wrong time. So you have to, again, step back and focus on fundamentals.
I totally agree with Tim in that they do create opportunities. There are value opportunities when you get oversold, and obviously you can sell. But, however, Tim is one of the true owners of the market. The institutional and retail investors are the owners of the market, as well as the corporate issuers.
Are there retail investors left in this market?
I believe they are. Certainly. I mean, they're in the
I'm being a little bit facetious, but we keep seeing these equity outflows, Joe. At what point does everybody just say, you know what, it's a rigged game, I'm out for good?
I think they've already said that.
I think they are saying that. What happened is we've gotten hijacked, okay? Our equity markets, what's supposed to be a capital formation process to have small companies get bigger, has been hijacked by the high-speed traders who have turned it into casino chips. So now stocks are no more than casino chips going back and forth, but you don't get a free drink at this casino.
Well, Joe, one of the things I look at here, when you talk about the high-speed traders, how much is it now that the high-speed traders, and Tim, it would be interesting to know what you think about this too, the high-speed traders are actually using the leveraged ETFs, combining them for an explosive event that And I don't know many people are talking about the combo of the two working in tandem.
The word that you want to use is a feedback loop. When you get into a feedback loop, which May 6th of 2010 was, where things start to get, the data starts to get corrupted and everyone's trading these same instruments, that's when Armageddon hits, okay? That's when you have big problems.
Tim, should we do away with some of these highly leveraged double, triple, quadruple, quintuple, whatever short, long ETFs they've got out there now?
Yeah, again, I'm a stock picker. I'm not a regulator, but that's a really good question. And I think structurally, U.S. authorities, European authorities, and folks in other important markets around the world probably need to take a closer look at some of those investment vehicles, because I think they are adding to the volatility. The one sort of another positive again in all this, and I think structurally there are some issues that have got to be addressed, is the one upside is when people really do sort of give up and throw up their hands at the margins, ETFs or no ETFs, there's no one left to sell, and there's a lot of people ready to buy. And if you go back and look at the early 80s, you didn't have this sort of volatility, but you had this sort of pessimism, and I think people giving up on equities. So here we are 30 years later, and we're going to work through this, and I think ultimately you're looking at fantastic long-term opportunities here.
Joe, quickly, do you agree with that? Good long-term opportunities? And also, I know you brought in some charts about volatility. What are they saying about where we're going for the rest of the year?
It tells you a lot. The volatility charts, by the way, courtesy of my friend David Wheel at Capital Markets Advisory. Great charts. It tells you that there is a lot of volatility. Although the high-speed traders will tell you that they dampen volatility, they do in the most active names. We're talking about the smaller to mid-cap names. The volatility erodes confidence. It drives money out of the market.
I am a buyer of the triple long Saluzzi. Thank you very much, Joe. Real appreciate it. All right, a double handshake for Joe. Tim, I do, but I'm not allowed, and you're not here. But thank you for coming on the program.
Next time. Thanks for having me.
All right, cheers. Speaking of rocking rallies, let's talk.